Hello everyone, Art Collins here. Want to lay some interesting stats on you today about the stock-related index markets. Specifically, what do we do when the market hits 1% net change up or down on the day? Let's start with some broad statistics about the S&P futures. Since 2010, there were 2,387 trading days, and of those 2,387, the futures closed no more than 0.5% higher or lower than its previous close, 1,289 times, or 54% of the time. Now that shouldn't be too surprising. It just means most of the time the market moves are not extreme. They're in trade rather than trend mode. S&P's closed up or down at least 1%, 526 times, or 22.04% of the time. They closed up or down at least 2%, 145 times, or 6.07%. And in the extreme crash or reverse crash situation, 38 times, it closed at least 3% up or down. Now, it stands to reason that we don't have to wait until the close until we see a percentage up or down move. What do we do with these when it's intraday? We might ask, will the large moves continue in the same direction, or are they going to retrace and get less extreme as we head into the close? Research can answer that for us. At least it can tell us definitively what happened during that 10-year time frame. And the answer is we want to follow the move. So I did an optimization study on different entry times of the day that you would enter if your net change was plus or minus 1%. Okay? Now, these percentages we're talking about, very simple calculation. It's the net change, plus or minus, divided by the previous day's close. So that'll give you a plus or minus percent that you're up or down at any time during the day. I think pretty much all trading software gives you that figure automatically. All right, so what these numbers here represent are the time of day that you enter once 1% is hit. You see 1% up, you go long. You see 1% down, you go short. This is 10 o'clock, or at 11 o'clock, 12 o'clock, 1 o'clock, 2 o'clock. And in the S&Ps, the best result we have is following the 1% move at 12 o'clock and holding it into the close. $27,000 over the 10 years, 345% return on account. You get that by taking the net profit, dividing it by the worst drawdown. So that figure gives you a percentage that your account would have increased had you started with your worst drawdown amount. Now, like with everything, I like to see further validation elsewhere, different time frames or different markets. Let's look at different markets. The Dow. All right. Probably not a good idea to do it in the Dow at 10 o'clock or 11 o'clock for that matter. But 12, 1, or 2 o'clock, you get some nice numbers. Best net profit would be initiating at 1 o'clock, but your best return on account, which I think is a stronger figure, would again be 12 o'clock, same as the S&Ps. NASDAQ just shows you how diversified these markets are sometimes amongst each other. The 10 o'clock period that was a loser in the Dow is the best net profit and return on account in the NASDAQ. What I also want you to notice, though, as you've been looking at this, is that consistency, right? Across the board. We only saw one slight loser in the Dow, Everything else, regardless of the time, has been a positive bias. Nice numbers. This is the Russell. 12 o'clock is again the standout on a net profit basis. For return on account, 2 o'clock. 687%. That's hefty. And finally, in the mid cap, we have a best net profit at 12 o'clock. Best return on account again at 2 o'clock. So in short, pretty much all the time frames we looked at worked across the board. You get to 1%, you want to go aboard in that direction. So when a net change reaches 1% from there, it is more likely than not to get even bigger, up or down. So keep your eye out for this. I'm working on the 2020 Almanac now. Supplement to beating the futures, the financial futures market. People that bought the 2017 edition got very positive feedback on that, so you might want to check this out. And please visit me at Art Collins Trading or write me art@artcollinstrading.com. Thank you very much for joining me.